Mabuhay. Welcome back to Financially Smart Pinoy. I'm Lex,
And I'm Vera.
and we are so excited to be with all of you again.
Especially you amazing Filipinos out there.
Yeah, looking to really take control of their finances, and build that financial independence.
Yeah, take charge of their future, right?
Yeah, exactly.
Become financially free.
So today we're going to be doing a deep dive into something that is absolutely crucial for anyone starting their investment journey.
Mutual funds and UITFs.
Yes. These are amazing tools that can really make a difference in your financial future.
You can start using them today.
So I think a lot of people, when they hear about investing in the Philippine Stock Exchange, they can get a little intimidated.
Yeah.
Like there's so many companies to choose from, so much research involved in picking individual stocks.
It's overwhelming.
It is overwhelming.
For sure.
Yeah, and this is exactly where mutual funds and UITFs really shine.
They're like a shortcut to investing.
That's a great way to put it.
Instead of you having to pick individual stocks, right? You're letting the pros do the work for you.
Okay, so it's like having a personal financial coach, but just for your investments.
Exactly. You pool your money with other investors, and that combined pool is then managed by an expert who builds a diversified portfolio.
Okay, so instead of buying shares directly from a company like I would with a stock, I'm buying units of the fund, and the price of those units goes up and down, like stock prices.
Right. And that price, which is called NAV or net asset value, changes based on how well the investments within the fund are performing.
Got it. Now, I've heard the terms mutual fund and UITF used kind of interchangeably sometimes. So what's the difference, and does it even matter to me as an investor?
That's a great question. So the main difference is in who manages them and how they're regulated.
Okay.
Mutual funds are run by investment companies,
Okay.
while UITFs are typically managed by banks.
So different bosses, but essentially they work the same way for the investor.
Yeah, pretty much. Think of it like choosing between Jollibee and McDonald's. They both offer Chicken Joy, but have slightly different recipes. You pick what you're comfortable with.
I love that analogy.
There you go.
So why should someone choose these funds over, going solo and picking their own stocks?
Two big reasons: tailored portfolios and diversification.
Okay, let's break those down.
Yeah.
Starting with tailored portfolios.
Yeah.
What does that even mean?
So think of it like this. Funds are like pre-built investment packages designed to match your goals and your comfort level with risk.
Okay.
Some funds focus on stable blue-chip companies for steady growth, while others target high-growth sectors like tech for potentially bigger but riskier gains.
So you're not just like randomly picking investments.
No.
You're actually choosing a strategy that aligns with your own financial plan.
Exactly. It takes the guesswork out of building a portfolio, especially when you're just getting started.
Got it. Now, what about diversification you mentioned that's especially important for Filipinos? Why is that?
Yeah, so here in the Philippines, we have this thing called the board lot system.
Right.
You have to buy a minimum number of shares to invest in a company.
Okay.
So if you wanted to diversify, spread your money across different companies, you'd need a lot of capital upfront.
I see. So funds let you diversify without needing to be a millionaire already.
Right. When you buy one unit of a fund, you're instantly getting a piece of a diversified portfolio. You get exposure to way more stocks and sectors than if you were buying individual shares. And there are even index funds that track benchmarks like the PSEI, where you can start with just 1,000 pesos.
Wow, that's really accessible. Okay, so let's get down to the nitty-gritty. How do these funds actually perform? Do they beat the market?
That's where things get interesting. We looked at some research by Efren L. Cruz in his article Money Matters. He analyzed Philippine equity funds over different periods, comparing their performance to the PSEI Total Return Index.
So did these funds consistently outperform the market?
It's a mixed bag. Some UITFs did beat the PSEI over 15 years, which is impressive.
Wow.
But no funds, neither mutual funds nor UITFs, beat the benchmark consistently over 10 years.
So past performance isn't a guarantee of future success, but it does give us some insights.
Absolutely. Now remember, risk is a part of any investment conversation. Mr. Cruz also used some risk measures in his analysis, things like the Sharpe ratio and the Traynor ratio.
Yeah, I've heard of those, but I'm not really sure what they mean.
Yeah, don't get too hung up on the technical terms, but essentially, these measures look at how much return you get for the amount of risk you're taking on.
Okay, so I need to balance potential returns with the level of risk I'm comfortable with.
Exactly. Understanding those risk measures is crucial, but it's a topic for a deep dive of its own.
Yeah, I was like, we'll have to put that on the list for a future episode now. For those ready to jump in and start investing in mutual funds or UITFs, what are the key steps they should take?
Here's a roadmap based on the advice from both articles we looked at.
Okay, I'm taking notes.
First, define your financial goals.
All right.
What are you saving for retirement? A down payment knowing your why is step one.
You can't get to your destination if you don't know where you're going, right?
Precisely, once you have your goals, assess your risk tolerance. How much fluctuation in your investments can you stomach? Are you okay with some ups and downs if it means potentially bigger returns down the road?
I imagine there are tools to help figure out your risk tolerance, right?
Yes. Many fund providers offer risk assessment tools and questionnaires. Step 3 is to dig into the details of the funds you're considering.
Okay.
Read fact sheets, prospectuses, those documents that tell you all about the fund.
Got it.
To understand things like minimum investments fees and holding periods.
Fees, can you elaborate on that a little bit?
Sure, you'll typically encounter management fees and redemption fees.
Okay.
Management fees cover the cost of running the fund, while redemption fees are usually charged if you sell your units before a certain holding period.
Okay.
Different funds have different fee structures, so compare and choose what works best for you.
Got it. So we've set our goals, figured out our risk tolerance, and done our homework on the fund details. What's next?
Now it's time to choose your fund. Look at the reputation of the institution managing the fund, their track record, remembering that past performance isn't a guarantee, and the specific type of fund, whether mutual fund or UITF.
Any key differences between mutual funds and UITFs to consider at this point?
Some mutual funds have upfront fees that banks typically don't charge for UITF, so factor that into your decision.
Okay. So I've picked my fund. What's the final step?
Open an account with a financial institution offering that fund. Often this means visiting their branch, filling out paperwork, and going through the Know Your Customer procedures. It's usually easier to open an account for UITF since they're mostly offered by banks, and most Filipinos already have a bank account.
That definitely sounds more convenient. But before we move on, we need to remind our listeners that investing in mutual funds and UITFs doesn't mean there's no risk at all, right?
Exactly. Diversification helps reduce risk, but it doesn't eliminate it completely.
So what are some tips for managing risk, especially for Filipinos?
Here's a practical one. Start with a fund focused on an industry you're already familiar with. It can be consumer goods, real estate, anything you understand.
Makes sense. If you already know the industry, you're less likely to be caught off guard by unexpected developments.
Right. Another reminder is that returns are not guaranteed and may not always beat benchmarks like the PSEI.
So this isn't about getting rich quickly. It's about building wealth steadily over time.
Exactly. And if you want more control and are willing to put in the extra effort, there's always the option of opening a stock brokerage account. That's something we can explore in a future episode, though.
Definitely. Now we've covered a lot of ground here, from the basics of mutual funds and UITFs to understanding risk and taking those first steps. But there's so much more to explore.
Absolutely. And we'll delve deeper into some fascinating international investment options in our next segment.
Don't go anywhere. Kababayans.
We
We'll be right back
stay tuned.
after a short break to continue our deep dive into investing.
Sounds good. All right, so let's broaden our horizons a bit, Look beyond the Philippine market.
Yeah, I like that.
One of the articles we dug into really highlighted some intriguing international investment options.
Okay, I'm all ears. I've always been curious about diversifying internationally, but it just seems so much more complicated
It can feel that way.
than just investing locally.
For sure. But the good news is there are some fantastic international index funds out there that make it surprisingly accessible.
Okay, index funds, those are the ones that track specific market indexes, right?
Exact. Think of it like owning a tiny slice of hundreds or even thousands of companies across the globe,
Wow.
all with a single investment.
Okay, so I'm basically taking my portfolio on a world tour.
You got it.
I love it.
And the article pointed to 4 funds that really stood out. The first is the Vanguard Total International Stock Index Fund Admiral Shares.
Okay, that's a mouthful.
They have a nickname for it. It's VTIAX.
VTIX, got it.
This fund tracks the FTSE Global All-Cap X-US Index, which means it covers a huge range of companies from all over the world, excluding the United States.
So I'm getting exposure to some of the biggest global players out there.
Hey, got it. We're talking Japan, UK, Canada, France, even China.
Wow.
And here's a fascinating detail. The fund allocates about 40% to European markets, followed by the Pacific region at around 27%, and emerging markets at 25%.
So a good mix of, established markets and up-and-coming markets.
Exactly. Now, another Vanguard fund that caught our attention is the Vanguard Developed Markets Index Fund Admiral Shares, or VTMGX.
VTMGX.
This one focuses solely on developed markets, those with well-established economies.
Okay, so if I'm looking for, less risk, maybe a little more stability,
Yeah.
this might be a better fit.
It could be. VTMGX is known for having a super low turnover ratio, which means they don't buy and sell their holdings very often.
Okay.
That's a good thing because it keeps transaction costs down, which can boost your returns over time.
Less trading, more growth.
I like that. Moving on from Vanguard, we have the Fidelity International Index Fund, or FSPSX. This one tracks a different index, the MSCI EAFE Index, which is another well-respected benchmark for developed markets, excluding the U.S. and Canada.
So it's similar in scope to that Vanguard Developed Markets Fund, but with some subtle differences.
Right. One key difference is that the Fidelity Fund steers clear of emerging market equities entirely.
Okay.
So it could be even less volatile.
Got it. Less roller coaster, more steady climb.
Exactly. And finally, we have the Schwab International Index Fund, or SWISS.
SWISX.
It also tracks that MSCI EAFE index, so you get broad exposure to developed markets in Europe, Asia, and Australia.
So another solid contender in the international arena. What makes this one stand out?
One word: fees.
Okay.
SWISX has one of the lowest net expense ratios among its peers, which means more of your money stays working for you and less goes towards fees.
That's always a good thing.
Right.
Okay, so I'm starting to see the appeal of these international index funds. It's like I can diversify my portfolio and tap into global growth potential without needing, a team of analysts to figure it all out.
Exactly. But here's the thing. As with any investment, we can't ignore the risks.
Right. There's no such thing as a free lunch in investing. So what are some of the key risks I should be thinking about when venturing into international markets?
Well, one of the biggest risks is currency fluctuation. Remember, these funds invest in companies based in different countries.
Right.
So the value of your investment can be impacted by how the Philippine peso performs against those currencies.
So if the peso weakens, my returns could be less, even if the underlying investments are doing well.
That's right. But the flip side is also true. A strengthening peso could boost your returns. It's a bit of a gamble for sure.
A calculated gamble, hopefully.
Hopefully.
Okay, what else should I be thinking about?
Political risk is another one.
Okay.
Political instability, policy changes, even geopolitical events in those countries can all affect your investments.
So I need to factor in not just the financial landscape, but also the political landscape.
Absolutely. And there's always the risk of liquidity issues, meaning how easily you can buy or sell your investment.
Right.
Some international funds might be less liquid than local ones, particularly those focused on less developed markets.
That's a good point. I wouldn't want to get stuck with an investment I couldn't sell if I needed to.
It's definitely something to keep in mind.
Okay, so we've covered international investing, the potential upsides and some of the key risks to be aware of.
Yeah.
But let's shift gears a bit and talk about a topic that I think can make even seasoned investors nervous.
Uh-oh.
Risk in general.
Risk is an inherent part of the investing journey, no matter where you're putting your money.
And I think it's something that a lot of Filipinos, especially those new to investing, might be hesitant about. So let's break down the types of risk investors face, particularly here in the Philippines.
Sounds good. Let's start with market risk, which is the risk that the overall market, like the Philippine Stock Exchange, could decline, taking your investments down with it.
So even if I've diversified my portfolio, I'm still exposed to the ups and downs of the overall market.
Exactly. And this risk can be even bigger during times of economic uncertainty, like recessions or political instability.
So staying informed about what's happening in the economy is crucial.
Absolutely. Now, closely tied to market risk is interest rate risk.
Okay.
This one applies mostly to investments like bonds that are sensitive to changes in interest rates.
Can you explain how that works?
Sure, when interest rates go up, the value of existing bonds tends to fall and vice versa. It's because investors can then find new bonds that offer higher returns, making those older bonds less attractive.
So if I own a bond paying a fixed interest rate and interest rates in the market rise, my bond loses value.
You got it. And this is relevant for Filipinos because our central bank, the Bangko Sentral ng Pilipinas, adjusts interest rates frequently to manage inflation.
Okay.
Those adjustments can directly affect the value of your bond investments.
Makes sense. So keeping an eye on the BSP's moves is important.
Absolutely. Now, shifting away from market-related risks, let's look at company-specific risks, sometimes called business risk.
Okay, what's that all about?
This is the risk that a specific company you've invested in could face problems, financial difficulties, operational challenges, you name it.
So even if the market as a whole is doing well, a single company could tank and hurt my investment.
Exactly. And there are tons of factors that can influence a company's performance: poor management, increased competition, even natural disasters.
Yikes. That's a lot to think about.
It is, which is why diversification is so important.
Right.
By spreading your money across multiple companies, you reduce the impact of any one company's troubles on your overall portfolio.
Don't put all your eggs in one basket, right?
Precisely.
Okay, now what about currency risk? We talked about that with international investments, but does it apply to local investments too?
It can. Even if you're only investing in Philippine companies, currency fluctuations can still impact your returns, especially if those companies have a lot of business dealings in foreign currencies.
You give me an example?
Sure. Imagine a company here that exports most of its products to the U.S.
Okay.
If the Philippine peso weakens against the U.S. dollar, the company's earnings in pesos will actually increase.
Okay.
Which could be good for your investment.
But if the peso gets stronger against the dollar, it hurts their earnings.
Exactly. It's a reminder that even with local investments, you're still indirectly exposed to global currency movements.
Wow. That's an important detail I wouldn't have thought of.
Right.
Okay. Any other risks lurking out there that we need to be aware of?
One more, we can't forget about inflation risk. You know, that sneaky force that makes the price of everything go up over time.
Yep. Inflation, the silent killer of purchasing power.
Exactly. If your investments aren't keeping pace with inflation, your real returns, the actual buying power of your earnings, will be diminished.
So I need to invest in things that have the potential to outrun inflation.
Right. And that's where equities or stocks can play a key role. Historically, stocks have tended to beat inflation over the long run.
But of course, stocks come with their own risks, as we discussed earlier.
Absolutely. It's always a balancing act.
Okay, so understanding all these different types of risk is crucial for any investor, right?
It is, and it's a lot to take in, but don't get overwhelmed. We'll break down some strategies for managing risk and making informed investment decisions in the next segment.
All right, sounds good. I'm looking forward to that. Okay, so we've covered a ton of ground in this deep dive, right?
We have.
International investing, all those different types of risk.
A lot to process.
Yeah, it can feel a little overwhelming at times.
It is, but understanding risk is crucial for making smart investment choices.
And remember, risk tolerance is not one size fits all, right?
Exactly. It's personal and can change over time depending on your life stage, your finances, even your emotions.
So, someone just starting their career might be a little bit more comfortable taking on risk than someone who's closer to retirement.
Right. That younger person has more time to recover from potential losses.
Right.
While someone nearing retirement might want to prioritize protecting what they've already built.
Exactly. And, life events like getting married, having kids, or buying a house, those things can also shift your risk tolerance.
Absolutely. Those milestones often mean bigger financial responsibilities, which might make you less comfortable with big swings in your investments.
So it's all about finding that balance between risk and potential return, and knowing that that balance can shift over time.
Precisely. And it's not always easy to figure out on your own.
Right.
That's where a financial advisor can be a huge help.
They can help you create, a plan that aligns with your specific situation, your goal.
Exactly. And they can guide you through those market ups and downs and help you adjust your strategy as needed.
So for our listeners out there who might be feeling a little bit overwhelmed by all this talk of risk, remember, you don't have to go it alone.
Right. There are resources and professionals out there who can help you make those tough decisions.
Okay, so let's kind of recap where we've been today. So we started by looking at mutual funds and UITFs.
Yeah.
Excellent options for Filipinos starting their investment journey.
Great starting point.
Then we went global.
Yeah.
Explored some really intriguing international index funds. And finally, we took a deep dive into, all the different types of risk.
The nitty-gritty.
Yeah, the nitty-gritty of risk that every investor needs to understand.
And most importantly, we emphasized the need to align your investment choices with your own personal goals, your risk tolerance, and your investment timeline.
Exactly. Investing isn't just about chasing the highest returns.
Yeah.
It's about building a secure financial future that supports your dreams and aspirations.
Well said. And as we wrap up this episode, I want to leave our listeners with this thought. Knowledge is power, especially when it comes to your finances.
So true. The more you learn, the more confident you'll feel making those smart financial decisions.
Exactly.
So keep learning kabayans. Explore those resources, ask questions, and never stop working towards your financial goals.
We're here to support you every step of the way.
That's right. Thanks for joining us on this deep dive into the world of investing. We're Lex and Vera, and this has been Financially Smart Pinoy. Until next time.
Mabuhay.